Good evening and welcome to the FITT Show. I'm Bobby Kinzer,
And I'm Thomas Doty.
and we are the FITT Show, financial information for today and tomorrow. Welcome to all our friends and viewers around the world. Yes, we are global, and we'd like to thank everybody. And we coming to you because we want to help our folks get their finances in shape. So, as always, can you please click on the share button in Facebook Live and also on YouTube? And in YouTube, click on the subscribe button. But make sure you share this information. Don't hoard it and hold it to yourself, ladies and gentlemen. I want to thank everybody. Last week, we had another exciting subject: retirement planning myths, and we dealt specifically with those. But today we're going to come and take another little twist, which is going to expand those myths, and we're going to talk about investing myths. But before I go any further, I want to remind you also, please put some things down in the comment box. So that gives us extra traction, and click on the like button with the thumbs up and the heart button because that also gives us traction. Though we've been actually expanding our audience in each week, so that's a good thing. And this is show number 72, so we moving right along, though. Moving
Cool.
right along. So, Dodie, with how we start and kick this thing off, we start with one of the hottest topics at the top of the scale, the stock market.
Yeah, this was just a crazy, crazy day.
Oh my God, was it?
It was like the biggest. Well, I'll just say it was the first time the Dow has risen 800 points after being down by 500 points. That had never happened before, and it's the largest one-day percentage gain since November 9th of 2020. And it was just a crazy day. The Dow went bonkers, and the issue is the uh, the stock. They know that the inflation is running rampant, and the CPI came out today, and it was higher than they expected it to be, and so the market took a big dive. But then it was like people thought about it and go, well, "Oh, that's already baked in," and that's when the market took the big upbeat. So it's hard to make sense out of it. These are just some crazy trying times, and as we always say, you got to kind of just keep your head down and wait until the dust settles. The things have to get better sooner or later. But the Dow had 6 straight losing days in a row before the day, and then the information came out. It was bad news at first, but then it turned into good news. But anyway, for the past week, Dow is up slightly, up 113 points, less than a half, up more than almost a half a percent. The Nasdaq, which has just been killed lately, is down 400 points over the last week, almost a 4% drop. And all the stocks that go along with that, Microsoft is down 5%, Tesla's down 7, Apple's down only 1.4. Apple has been hanging in, and Pfizer is pretty much flat. But this is going to be a volatile period because now the Fed's going to probably announce another uh, interest rate increase, and everybody's expecting a 0.75 basis point increase, but there's now some talk that it may be over 1%. I mean, a 1% increase, which again, the market will react to. But I think you have to watch out for in the next couple of weeks is a lot of companies will be announcing earnings. And there's kind of this thought that most companies are going to be short of their forecasted earnings. But if we get some positive traction there and a couple of companies do better than expected, things might turn a little more positive. But I don't think anybody's banking on that. So again, just hang tight, think long term, and don't get caught in the day to day.
Yeah, that's sometimes easier said than done. But the thing about it though is so many myths and stories out there, and people get caught up into a lot of people talking about get rich quick schemes and this particular cryptocurrency. There's so much misinformation out there, but
You
yet,
you didn't give your update yet.
well, it's one of those days, though.
What's going on in the crypto world, my brother?
I don't know. I don't give a damn. No. That's why I didn't want to talk about it. I'm trying to ignore that daggone cryptocurrency. But yeah, though, the cryptocurrency market is down 70%. Yes, 70, ladies and gentlemen. And the market cap for the entire cryptocurrency market of over 18,000 cryptocurrencies was at 965 billion. And that is down approximately $31 billion. The Bitcoin last week was at $19,941. Today, it was down to $19,390. So, it's a dip. It's taking a beating. But today, believe it or not, just today, as of 7 o'clock, it was up 1.1%. Bitcoin's still the number one currency, and its market cap is at 371 billion, which a year ago it was at over $1 trillion. So a lot of people are sold off. We still believe in the long play with cryptocurrency. Shiba Inu, it's just been holding at 0.00001, and its market cap is down, but believe it or not, just today it's up 3%. Dogecoin, which a lot of people still invest in, is down 1 cent. Last week it was 6 cents. Now it's 5 cents. But it's been off today, and it's still holding at the number 10 position though. So as we always say, it's just another investment option. But if you're going to play, just make sure you know what you're dealing with, and don't make those speculative investments a major part of your investment portfolio. And particularly, they sometimes say anywhere between 3% or less, but that's just the benchmark that they give. Now, Dope.
Okay, let's get into today's topic. And as you were saying, Bob, the investing world, it's everybody's got advice, and right now, people can put any information that they want on the internet and push this and push that and say things that aren't true, and people just get it and run with it. And trading has become so much easier now. You got Robinhood, you got Cash App, you can buy and sell stocks fairly easily. You can buy them in fractions. You can buy cryptocurrency, real fast, and a lot of these things you can buy with no fees. And so everybody has access to Wall Street. But again, you got to be careful not to make a move that's really not thought out, or is based on information that may be outdated, or based on information that may work for somebody else but not work for you. And as with any other subject, you just got to be careful of what you pick up on the internet.
Yeah, it's so much out there, though. I mean, there's so many investment opportunities out there, and like I said before, there's over 18,000 cryptocurrencies that you can invest in. And in 2019, though, there was nearly 8,000 mutual funds that a person can choose from. So where do you turn for accurate information? Who do you ask for good advice? How about the investing myth about risks, though? Now, actually, risk means different things to different investors depending on their circumstances or their position in life. So a lot of people can tell you this and that about risk in investing, but a lot of it is, you need to look at the current investment landscape through the lens of different generations and investors. But today, we're going to discuss some of the investing myths, and hopefully we can put some of them to bed. Don't want you start with the first investing myth?
Yeah, the first one is that investing in the stock market is only for retirement. And many people have taken advantage of 401k plans, those employee sponsored retirement accounts, and employees put money away, and employers match contributions, and hopefully you've been maximizing your money in there for years, and hopefully you're saving at least to the extent that your company matches, and even more hopefully is that you're saving even more than that, and that's all well and good. But a lot of people have the rest of their money just sitting in checking or savings accounts, and we've talked, um, you know, a lot about how they hadn't been paying very little money. Even now, with interest rates rising, you really have to do your homework to find a checking account that pays a decent amount, or a CD that's paying a different amount. You really have to be on top of it. So you should have that money also growing in the stock market, just as you do your retirement money. And a lot of people do that. They're real diligent about saving in their savings plan and putting money in there, but they don't worry too much about what they have outside of their savings plan. And retirees put money in retirement accounts. That's all well and good, but you should also have a brokerage account that's just for investing, just for saving money. And savings and checking accounts, they're all well and good for your emergency funds, or to have money that you're going to need access to within the next year, but or even for daily expenses. But the rest of your money should be working for you. And it feels kind of funny saying that now with the stock market tanking, but as we've always said, this has happened before. It's going to happen again. The stock market's just not going to continually go up, and we are firm believers in not trying to time the market. So both of us have always been fully invested, and that's what you should be doing with your spare money, is making sure it's working for you.
Well, the second myth, though, and this may sound very common and very Captain Obvious, but investing is a way to get rich quick. Now, reason why this is a myth, which a lot of people know that sometimes most people don't believe that it is, but it's so amazing though how some people fall into this. Because when I was a stockbroker registered representative, I would tell people, okay, give me this money, put it away for 5 years, and it probably would double. Man, they would call me within 5 days panicking, because they're expecting like a 50% return. They were expecting all of these outrageous returns because although people, know that investing is about timing in the long-term play, one of the surveys that came out talked about one of the biggest detriments to investing. Number one, though, was patience. Most people don't have the patience to put the money away and let it grow for them and compound over the years. So you look at the meme stocks and the cryptocurrencies and the NFTs, the non-fungible tokens, they were booming. And while it seemed like investors, were becoming millionaires overnight, it's actually really, really hard to do. You really need to, investors really get rich off of speculative assets like cryptocurrency. That's what they say in the market, but you can make money in it. That's the alluring factor of it. But having the appropriate asset allocation is really most important than anything. For example, having the right ratio of stocks and bonds and having a discipline to stick to long-term plans are much more important for long-term success. And many, registered advisors, they recommend that you have allocation, and I said it a little bit early, of no more than 2%, or no more between 2%, no more than 5% at the absolute most in speculative stocks. But investing isn't about getting rich quick. And if you have the patience and put the work in, you can be successful.
And Bob, as we always say, those percentages are averages. Okay, they may not be for you. Like, we say no more than 5% in risky assets. But if you're in a position where you don't have much debt, you have a healthy nest egg, you may be able to put a little bit more into something speculative, because we always talk about no risk it, no biscuit. But when you put money into something speculative, you got to realize that it could take a big hit very, very, very quickly. And so that's the thing that should guide you. Everybody's situation is different. A lot of the percentages out there are averages, and they're not for your particular situation. So you got to be careful when you hear, okay, only put X amount in this, or only put X amount in that. And it's funny, Bob, you talked about like the get rich quick scheme. I remember the first time I bought some stock, and again, it was outside of my company savings plan. And it had to be 78, 79. And started dealing with a broker, had a little bit of money to invest, and he recommended that I buy MCI stock.
Oh, I remember that.
And I bought it at like 10, and within a week, it was up to 15. Now, I just made 50% on my money in a week, which if you calculate the annual return on that is something crazy. And I'm ready to sell. I'm like, hey, I made 50%, let's sell. And fortunately, my broker was a good dude. And he said, no, just calm down. This is a long-term situation. It has a lot more go. He said, if you need the money, then maybe you should sell. But if you don't need it, let it ride. And of course, it did very, very well for a long time. And, if you think back to having bought Microsoft in the mid 80s or 90s, whenever it became big, had you just left your money in there, you'd probably be, living somewhere on an island that you own. But you have to be patient. You have to know what you're doing, know what you're trying to do, look at your situation, figure out what works, and then go with that. But again, be cautious of percentages. And that's myth number 3 I'm going to talk about. And that's always said as your stock allocation should be 100 minus your age. And for a long time, that was always the rule of thumb. Take 100 minus your age, and that's how much money you should have in stock. If you think about it, if you're 25, that means you got 75% in stock. If you're 60, that means you got 40% in stocks. But you think about that, the lifespans are increasing, and we've talked about that. And so that information was probably relevant at a particular point of time. But if you are going to live to the 70s, 80s, 90s, and you got 30% of your money in the stock market and 70% in something safe, you could conceivably run out of money and leave a lot of money on the table. And so a better approach right now, if you need an average number, is just subtract your age from 110. And that's how much you should have in stock. Again, those are just averages. You need to sit down and figure out what your particular situation says you should do. But take, for example, if you're 80 years old and you got 20 million bucks and you spend 200,000 bucks a year, and you want to leave money to your children or grandchildren or charities, whatever it may be, you might have up to 90% in equities if you got enough money to live on and you don't need the money because you're looking to build and grow. And so that might be what's best for that person in that situation. So you have to look at your own particular situation, determining what your risk tolerances are, what your money needs are, and that determines how much money you have in stocks versus something safe. So you have to really be careful when you hear those percentages and realize that's an average and it may not apply to your particular case.
Well, that's good advice, though. Myth number 4 is gold is the best inflation hedge. Now, dope. A lot of back in the day, man, gold was one of the top commodities to have because even the United States system was based on gold in Fort Knox. But I think we got off of gold even around Reagan. I think was the last time we sold our gold to England, and that's when we went off the gold standard. We now have something called the M1, M2 formula, based on savings accounts and savings accounts and another kind of formula, which is not backed by a solid concrete asset. But gold, though, I've always been into this because when I was closing bikes around the country, I would go into pawn shops and I would check with guy. And this guy in Iowa once told me, he said, son, you must always have some precious metals in your portfolio. Once you get your portfolio straight with the standard products, you should have some gold in it because gold, has for long been considered a way to protect a portfolio against inflation. But it's not actually a good inflation hedge these days because the gold has been going down. And I'm like, wait a minute, I thought it was supposed to be having the opposite effect. But what happens is gold, well, let me just say, the precious metal got this reputation because it's believed that as prices rise, so does the price of gold. But history has shown that gold has actually yielded a negative return during some of the most inflationary periods. And I'm like, wow. But gold does best when the US dollar is losing value compared to foreign currency. So a weak dollar would benefit gold investors. And right now, though, the dollar is getting strong. The dollar is going up, matter of fact, which is so interesting these days. In a period of rising inflation, it would tend to weaken the dollar, but it's not. So this is kind of counterintuitive these days, because usually inflation benefited gold. But high interest rates, which tend to go up with inflation, could suppress the price of gold. Now, gold is a good currency hedge. Like I said, if the dollar is losing value, it's one of the reasons why they created cryptocurrency is to counter the dollar because the dollar was losing its value. They were looking at the Federal Reserve just printing, having the Treasury print so much money that the dollar was losing value. But now, all of a sudden, the dollar is really picking up. And many financial planners recommend holding, a small amount of gold. And once again, just a rule of the thumb, a benchmark measurement, like, no more than 5%.
Yeah. Okay, myth number 5. You must pay off all your debt before investing. And obviously, it's important to make sure you got a solid, strong financial foundation before you invest. But that doesn't mean you got to wait until all your debt is
Excuse me.
paid off before looking at the stock market. Obviously, you should pay off any high interest debt, like credit cards, before you start investing. But if you have an employer 401k that matches, you can't afford not to be in that. That should be automatic. You ought to be in that regardless of what your debt is. But you can't afford to wait until like all your student loans are paid before you start investing. We always talk about the value of time and compounding. And if you're waiting to invest, you're missing the opportunity for your earnings to grow and compound because time is the biggest asset you have. I mean, that's we've talked about that a lot, and that's kind of the key to both Bob and I's, me and Bob's success is that we're old, but we both have been invested for a very long time and have reaped the benefits of compounding and have been able to make a lot of money in the stock market because we were invested. And so that's really, again, we're not advising, but we're just telling you what our situation is. We both have done quite well by being invested. And I don't think either one of us have been particularly risky or speculative. I'm a little more, I accept risk a little more than Bob does because, Bob's a conservative guy when it comes to investing. But I'm a little more aggressive. But it's times like these where Bob has probably lost less money than I have because I'm more aggressive. But again, I'm willing to accept that. But everybody's situation is different. But you got to be in the market. I won't say you have to be. It helps if you're in the market, and the money you can make by being in the market is tremendous, especially if you start young and you have time for it to sit there and grow.
Yeah, dope. That is such a interesting myth where people think about paying off their debt, but
That's a good thought, right? It's a good thought, but again, you're missing out because Bob, we are so against trying to time the market. And the best time to get in the market is right now. Even as the market is down 25%, that's even more of an incentive to be in it because it probably won't go a whole lot lower. But again, that's not timing the market. But if ever you needed an excuse to get in the market, this would be the time.
though we got a question in the comment box, and the question is, why do you think most black people why do you think most black people are afraid to invest?
I can speak to it from my point of view, and even having been educated, I got my degree in accounting at Penn State. I still didn't know a lot about it because it wasn't discussed, during dinner at my house. And so, in my case, a lot of it was ignorance. I just didn't understand the long-term positives of investing, and I think that happens to a lot of people. And I think you are hesitant because it's kind of like gambling, as when you first learn about it. So I think a lot of people are just reluctant to do it. And some of the things they think it's only for rich people. They think it's you need a lot of money to invest. These are all reasons that folks tend not to invest. And the other part that I think keeps people from investing is you have to have patience, and it's not something you put money in and you get something right back, because you may invest money, it may even go down at first, but we live in such a materialistic society too that people like to have gratification. And I always, I would always tell my kids, be happy with your bank account. Make that a reason you're happy that you have a bank account, not so much a new purse, or you driving a foreign, or you got this handmade suit. Be happy that your bank account is fat. And that's something that most black folks didn't grow up thinking about because we had no bank account. And so it was a different mindset for me. I can't speak for a lot of other people, but I think the same thing that happened to me would happen to a greater extent, even for people who didn't have an educational background that I was fortunate enough to get. I still was hesitant to do it. And when I got in, I really didn't know what to do. And that's, again, that's one of the main reasons Bob and I are doing what we're doing now, is just trying to get people at ease and to understand more about it. And once people understand more about it, I think it'll be a lot easier for folks to invest, and you can knock down a lot of the barriers to people investing. That's a long-winded answer. I hope it makes some sense, but I think that's a main reason why a lot of folks don't invest.
Garnett says the market scares me.
And it should.
And it should. It
should.
does.
And that's why you go in and measure doses. We always talk about understanding your risk tolerance. And if it scares you, then you shouldn't be in it to a great extent. But this is another one of those things I always tell my kids. You can be afraid of the market, but then that means you have to be satisfied with the results you get from being afraid of the market. And they are going to be considerably less not invested in the stock market versus being invested in the stock market. So it's okay to be afraid of it. You just got to be willing to accept lower returns. And so you have to find that point for you personally where the risk is worth the reward. Okay, so you invest enough where you're satisfied with the return, but the risk is not so great that it keeps you up at night and doesn't allow you to sleep. So it's a thin line, but you got to find where you're comfortable. And and if you're just totally not comfortable investing and don't invest, then by all means do not. But again, you got to be happy with the results. In times like these, inflationary times where inflation's up 9%, that $100 you have in a savings account is worth $91
Right.
at the end of a year.
You're
So
losing value. Your
yeah,
purchasing power is losing.
yeah,
So don't,
that scares me more than the market does.
right. But most people don't look at the time value of money, though. But my two reasons, though, my number one reason, this is just my opinion, why Black people don't invest, is I think it's mostly knowledge. We just didn't have the knowledge. This is about understanding. And that's why we created this show, to give people the knowledge. And I think that's the number one reason, though, that people just don't know and they don't understand. And one thing we talk about the show, when it comes to financial management, personal financial management, you don't have to have no degree in college. You don't have to have no kind of financial degree. That's the thing about this financial management, man. It's just knowledge. And nowadays, though, there's so much information, just like we pulling things from the Kiplinger, which gives us so much great topics to talk about. It's about knowledge. And the second thing, though, that I personally think, I think a lot of how we talked about how we are like some of the sort of like the first generations to be thinking about, what we need to do with a 401k plan or an IRA or, brokerage accounts and stuff like that. Most people, it took them so long to get to where they are right now. They're afraid to lose what they have.
And Bob, let me add to what you're saying, because I agree with you 100%. But the third thing I'll add, and a lot of people may get mad at this, and I don't care, but a lot of people don't want to put the work in.
Ah,
And it takes effort to sit down and analyze your risk, to seek out the best investments for yourself, or to go out and hire a financial consultant to help you get the right investment for you, to follow up, to rebalance your account, to reallocate, to look at what the market's doing, to do research. That takes work. And that's one of the things that I was always blessed with, is the desire to want to learn and the willingness to do whatever work was necessary to accomplish whatever I wanted to accomplish. And so I've always been heavy into reading what the stock market is doing. And I'll admit I'm a nerd. I mean, I don't run from that. I enjoy that. And a lot of people don't. It's not the most exciting thing to do. It's not exciting to sit down and do a budget. I enjoy it. It makes me feel good to sit down and do a spreadsheet and my columns tick and tie and all that stuff. But for most people, that's mundane, uninteresting work. And a lot of people don't want to do the work necessary to fully manage their financial situation. And it goes back to what Bob said. You weren't brought up doing it. You weren't raised. That wasn't part of your life to do that. And that's one of the things that I hope I instilled in my kids, is to make that part of what they do in reviewing their financial resources. But it's no different than anything with Black folks. It's like medicine, Bob. I didn't grow up going to the dentist. I never went to a dentist till I was 18, because that's just not something we would do. If your tooth hurt, like Chris Rock said, your mother would say, put some rubber tussin on it and call it a day. But
right.
now, my kids have gone to the dentist every, twice a year for all their lives. And so it takes some time to learn good habits to make them part of what you do. And to start at 25, 26, it's difficult to do, to start doing that when you have that thing called life going on and sucking you into 101 different directions.
So that whole wealth gap conversation, Nolia, my sister says most black folks were kept out of the game.
It's
Without a
part of it
doubt.
too, no question.
That's part of it too.
Well, yeah, you could talk about the housing situation, which is the easiest way, the way a lot of people have built wealth. And you go back to, guys coming back from the service, and whether it's World War II, Vietnam, or wherever, and they couldn't buy a house in the areas that were high growth because they were redlined. They were kept out of those neighborhoods, or they were segregated. They weren't allowed to buy in there. And then a lot of the homes in the inner city were considered too risky. So you couldn't get a house in the inner city because it was too risky or too high risk. You couldn't get a house in the suburb because of your race. And so you missed out on one of the biggest ways people use to get rich, and that's owning a home. So yeah, we were kept out of the game. And then you throw in predatory lending practices and all the other things we've talked about. So she hits on a really good point. You add that in with the lack of knowledge, the fear, the it not being part of how you think in general, and it should be. Just we had the show on health, Bob, and making that part of how you think. Well, financial, just thinking should be part of how you think, but we aren't there yet. We aren't there yet.
And it's cultural though, because I noticed at my job where the Jewish community were at birth, they were putting stock certificates in the baby's bassinet. And I looked at some of my friends, they were buying the baby Jordans to put on the baby. Now, I'm not trying to ridicule, I'm just giving an example that it's just cultural, man. And we
And
just need.
I think sometimes when you're down, you look for anything to make you feel good. And it might be a pair of Jordans. It might be
True.
a throwback jersey. And so I can't knock nobody for liking what they like.
Right.
But again, it's just really important to instill in your kids some financial discipline. And it's understanding a budget, understanding to only spend what you make, to not learning to say no when it's necessary to say no, and not to buy the high end if you can't afford the high end. So it's all those things that we didn't really learn growing up. We really didn't. I know I didn't. I can't speak for everybody, but I know, like you said, birthday. I never had a birthday party growing up, so I didn't get anything, and it wasn't a big deal because as a kid, you don't know what you don't know. You ain't missing nothing that you never had. So yeah, there's a lot of reasons, but hopefully we've touched on a lot of them, and hopefully we can get rid of some of those by giving our kids knowledge and tools.
Don't you just resurrect a lot of a feeling that I'd had that I suppressed for years growing up. We live with meager means, we just live within our means. And I never forget, man, I wanted one of those G.I. Joe dolls with the Kung Fu grip so bad. But them things cost. And what my mother bought me? A bag of those 100 Green Army men.
Oh my God, with the machine gun, the
Yeah,
sniper,
but it was only three. It
yeah.
was only three. It was only three positions, but
Yep.
it was 100 in the bag.
Yep. I had that same one.
It was just three positions. I'm thinking I'm getting a G.I. Joe doll, but I'm not knowing that my mother really can't afford that. But you know what? I made the best of that mug. You know how you used to go pew, pew, act like you were shooting. So, it's cultural, man. But I thank God for my growing up because I learned how to appreciate things definitely and value things a whole lot better.
Yeah.
No,
Go ahead.
the number 6 myth. Investors need to constantly check their investments. Now, I know this is one of yours, though. You have sometimes a viewpoint that you have, but one of the misconceptions is that investors need to pay attention to every piece of financial news, like stimuli or new investment ideas of the day. Just some people just feel they gotta be up on it every day, listen to new and more information. But that can do more harm than good. If it tempts you to take actions, investors should spend more time thinking about their financial responsibilities and their goals than trying to time the market. We always talk about that. You can't time the market. You can't time the market. So it's best to focus in on your financial goals and be disciplined to follow and stick to them. Because there's a more direct path to college or retirement savings than picking the right meme start. This isn't to say that you shouldn't check on your portfolio or rebalance your allocation regularly, like once a quarter or a year. But while it's easy to get distracted by headlines in the news on the front pages or people, telling you, the newest and greatest financial advice, but, you know, it's easy to get caught up about inflation and the tax changes and worry that they may end up, decreasing your savings, or maybe they might be destroying your investment. But those events are likely aren't going to mess up your long-term plan if you make it realistic goals, what they call SMART goals, specific, measurable, attainable, realistic, and timetabled. And just stick to it. It doesn't matter. It doesn't matter how much different news there is. But so don't get caught up in checking it every day on the hour, because although it's good to check, sometimes it can do you more harm than good.
Yeah, and Bob, there's nothing wrong with getting the knowledge because I'm all over that stuff. I'm looking at everything that pops up on my screen. But again, it doesn't force me to make a move. And if you have limited time to spend on that part of the financial part of your life, that time is better spent, as Bob was describing, reviewing your savings, uh, strategizing your long-term plan, spending time with things that you control versus looking at a whole bunch of information that you have no control over, you have no input in, and there's really nothing you can do about it. But there are some things in your financial life that you can control, and your time is much better spent doing that than worrying about things that you really have no control over.
That is so true, Dope. That is so true. So, Dope, let's go. Let's go to the recap, to the summary and takeaways, because we talked about a lot tonight. But let's recap for everybody so that they
Okay.
can see where we are.
And again, investment is not just for retirement. That should be part of your life, part of how you think, part of how you deal, and you should allot some time for it. Take care of your retirement, invest in your company's 401k plan, save as much as you can in there, but also manage the money outside of there and invest any extra money that you have.
Investing is more than taking risks. Investing it should be like just as common as, you talk about sports, you talk about entertainment, you talk about any other thing. That should be a part of your everyday life. Investing should be something that's just as common as breathing, because it's so important, and it's the way, and it's been proven that you can become successful in creating wealth. So it's not just about taking risks and sticking your head out there and going on a limb and putting your family assets out there at risk. No, it's more. Investing is a way of life, meaning you should be thinking about it every day, and well, not every day, but you should be thinking. It should be just as common as a lot of the other things you think about. When you go out there and you notice that the prices are, they do got to sell at Walmart. You go out there and buy those things that are cheaper at Walmart. At Target, you go and see things on sale. Why don't you do the same thing as the stock market? You see it's down. You see you get a discount on some of those stocks. That's what I mean by investing more than just taking risks. It's also a strategy on how to build wealth.
Okay, next we have successful investing requires work. I touched on that earlier. It does take effort to understand where your money's going, to successfully do a budget, to understand what your goals are, what your risk tolerance is. And I told you a lot of things that I consider myself pretty well educated financially. And there's a lot of surprises that still I came up against. I've mentioned the Medicare IRMA payment, where it's based on your income, the different situations in the stock market that you need to know about. Like we've talked about a wash sale before. If you sell a losing stock, you got to wait 30 days before you can buy it again, or you lose that capital loss. And there's a whole lot of tax issues, which I'm pretty well up to snuff on taxes, but that changes every year. So you have to stay up on those things that affect you. And so much, and that's another reason that we talked about why, Black folks don't get into the market. But and Bob said knowledge, and that's so true. And a lot of times it's a moving target, like the tax situation, or the Medicare open enrollment, picking the right Medicare plan, or there's so many things that it takes work to successfully navigate your financial situation. You have to put some time in order to be successful. You don't just build wealth by accident. So it does require some work.
And the last one that takeaways from today is investing takes sound planning and patience. Um, we know we probably sound redundant and sound like a broken record, but we always talk about the foundation of any wealth creation is having a plan and sticking to it for the long term. But what we want to add to that is you must be patient. You must be patient, and patience creates discipline. So it's very important, you all, that you stick with your plan and don't get caught up into the news, the headlines, or the things that people are saying out there on social media. Because if you have a sound plan, and remember, review your plan because every now and then you may need to adjust your plan. It's okay. But if you have a plan, it's just like the old saying, if you don't plan, then you can end up on the rocks. So people don't uh, fail to plan. They plan. No, people don't plan to fail. They fail to plan. So think about that, you all, because there's a lot going on out there, a lot of misinformation, a lot of myths. But we hope we covered a lot of them for you today. And there's so many more out there. And so y'all can check them out and go out there. There's some great publications out there. FSPD.org has a wonderful newsletter out there. And Kiplinger also gives great information. So, dope. As always, as we give our shout out, and at the top was who came on first. It doesn't surprise us. Was Garnett? What's up, Garnett?
Hey, Garnett.
We love you, girl. And then the other person that sometimes she beats Garnett is my sister Linda. Thank you. And Joanne, also another stalwart. And my brother, Carl Chapman. What's up? My sister Nolia, she's another stalwart. Thank you for hanging in there with us, Nolia. And the noteexperience.com. My man, Rodney Madison. Appreciate you sticking by us, Rodney. Appreciate that. And who else we got out there? That's everybody. And hey, now, thank you for checking out and giving us props. And we just want to let you know we here every Thursday. This is our 72nd show, dope. That's some serious, man. I still can't believe we've been rolling, man, and things been coming up. Life events happen, and we're still pushing through, you all. So thank y'all for supporting us. And like we say, please share this link with other people because that's part of the journey and part of our mission. We want to get it to as many people as possible. And out on YouTube, please, um, uh, what is it called? Subscribe. Sorry. Please subscribe if you're out on YouTube. And you can also share on YouTube. So with that, don't you have any more lasting comments?
No, it's been enjoyable. As usually, you keep it live, Bob. You do.
All the way live, and you give great information. Though we're a team, buddy. So we'll see you next week. Same bat channel, same bat place. The FITT Show. Financial information for today and tomorrow, 8 p.m. every Thursday. Thanks, everybody. And